Private equity has been saying they have been looking for a downturn, hoping that valuations will become more attractive. Now that we seem to be getting closer to it, where is the risk and where is the reward?
Listen, we still have record amounts of dry powder out there, so people do believe that maybe it's time to put it to work once valuations come down. But guess what? Just because markets are private doesn't mean that they're immune to the risks that the rest of the global financial system faces. So if the growth in the economy starts to slow, the portfolio companies will also start to feel those hits, especially in certain industries like energy, travel, and lodging.
And are we seeing any signs of either existing deals that have gotten done having stress or potentially deals in the pipeline?
Well, listen, also, it's not even just the portfolio companies getting hurt, it's also the exits. The IPO window is not open right now, and M&A is also quite challenged. With that said, we have seen deals. And Steve Schwartzman, the CEO of Blackstone, has said it is the time to buy. But really, we have other people that take a much more tempered approach to this and say we're not going to know until the dust settles.
So how do we even gauge the risk versus reward? I mean, are you looking at their share prices of some of the KKRs of the world and the Blackstones? Are you looking at just sort of what they're saying?
It's a great point because we didn't have their share prices to use last time around. You do have to look under the hood because it's not just private equity. A lot of these firms have big energy portfolios also. The energy industry is completely roiled right now. And so if those companies can't pay back their debt or there are other issues there, then the Blackstones and Apollos of the world will feel more pain.
And we're going to be speaking a lot about energy debt and this pain that we're seeing within the energy complex throughout the show. Kelsey, on a broader sense, though, there is a question of when firms are willing to step in. We've been hearing they have all of this dry capital, as Sonali was saying. So are you hearing about a lot of them stepping in, or are they waiting for some of this to subside?
So a lot of them are saying that they're ready to pounce. They haven't quite done it yet, but there's certain...
They're ready.
They're ready.
But they're not doing it.
They're not doing it yet just because the situations that we've seen at this moment aren't necessarily meeting their risk profiles, but that doesn't mean next week things can't change completely. They're sitting on billions of dollars of capital, and this is what private credit funds do best. Step in when no one else is lending and basically meet that need.
Although there's a question at what level, right? I mean, a lot of people are saying that this is a cash crunch for companies that are uniquely hurt by perhaps the economy slowing down, given the coronavirus concerns, immediate cash flow issues. Are they willing to pounce at a level that makes sense financially? In other words, how distressed do things have to get? I mean, what are you hearing from people in terms of how much further the sell-off needs to go?
So a lot of them are saying that we're very close to that tipping point where they will step in. Again, things just change from day to day. So it's very, what they may see as an opportunity yesterday, tomorrow might be completely different. But one thing I will say about the private credit funds is ultimately, even though they are seeing these opportunities, they are a little bit nervous as well because they are lenders to virus sensitive sectors like travel, like gaming, lodging. There's over $200 billion of private debt that is lent to those types of sectors, UBS says. So they may be feeling the pain as well.
Well, talking about pain, let's talk about energy. Allison, the biggest disruption recently has been in energy-related assets. It's been pretty rough. Can you give us a sense of just how tumultuous this picture has been?
It's been really rough. We saw a pretty remarkable reaction in the market yesterday. Crude oil fell more than 30%. And alongside that, we saw energy credits just really across the market plunge 10, 20, even 30 cents on the dollar. Practically the entire high-yield energy market is trading like it could default at any moment, that some of those companies could be filing for bankruptcy.
Allison, I was looking at the spread, the extra yield that investors demand to own energy junk bonds over benchmark rates. It surged by more than 3 percentage points yesterday. This is unheard of in the history of the index in terms of a one-day jump to more than 14 percentage points over benchmark rates. I'm wondering, from your perspective, it looks like a falling knife. Are there people you're talking to who are catching it?
Not yet. I think a lot of energy investors are still hiding under their desks, quite honestly, trying to figure out where things are going to ultimately land and where the dust might settle. That being said, we are seeing more relative calm in the markets today. WTI is hanging around in that sort of low $30 a barrel range, and we haven't seen as much movement in energy credits. So I think we're going to start to see investors maybe stick a toe back in, start to wade through some of the wreckage, and see where there might be some deals now that we've seen, relatively speaking, a bit of stabilization.